My name's Ethan Braid. Today we're going to compare CDs to T-bills for the conservative investor. I think you're going to be surprised by which investment comes out ahead. We're going to compare CDs to T-bills in three different categories because they're not the same in these three categories. First is going to be taxes. Second is going to be commissions, and third is going to be risk. Here is an example so we can see the difference in taxes between CDs and T-bills. We're making a one-year term investment. We're putting $1 million in a CD and $1 million in a T-bill. The interest rate is the same on both investments at 5%. At the end of the first year, we've received $50,000 of interest. But here is where the difference is between CDs and T-bills. It's at the state income tax level. CDs pay income tax at the state level at ordinary income tax rates. T-bills are state income tax free. That's right, you don't pay any state income tax when you invest in T-bills. So what ends up happening is the T-bill puts more money in your pocket on a net basis. In this example, the investor lives in a state that charges 6% tax rate, so they end up paying $3,000 of taxes that they would not have paid if they had invested in a T-bill, and therefore the T-bill comes out $3,000 ahead on a net basis. Here is a look at income tax rates across the various states. You can see that if you live in a high tax state like California, Oregon, Minnesota, Wisconsin, or New York, you're going to be paying a lot of money on your CD interest in the form of taxes at the state level, and that will make T-bills much more desirable. Most states are going to be in the 5 to 6% range for state income tax that you will pay on your CD interest, and some states like Florida, Texas, South Dakota, Wyoming do not have an income tax, and therefore your CD interest will be tax-free at the state level if you live in those states. So when you're trying to decide on investing in a CD versus a T-bill, you need to consider the applicable income tax rate for the state that you live in so you can calculate the difference between a CD and a T-bill on a net of tax basis. Aren't those tax differences interesting? Depending upon what state you live in, a T-bill may put a lot more money in your pocket on a net basis versus CD if you live in a state with a very high income tax rate. Also, federal income tax is going to be the same for T-bills and CDs, regardless of what state you live in. So the decision point and the evaluation that you're going to perform is going to be based on the income tax rate for the state that you live in when you're trying to decide, where will I earn more money? Will it be on a T-bill or a CD? Now let's talk about fees and commissions. You can buy T-bills from Treasury Direct with no fees, no commissions. That's right, nothing. You can buy them from a brokerage firm for a very, very small markup or commission. But CDs, well, that's a different story. Over the last 25 years, I've seen many investors' brokerage statements where they have a broker who's selling them CDs. And they don't realize that the broker is getting a hidden commission. And the commission on CDs is far, far greater than the commission on a T-bill. And I think this is why so many people, where I've reviewed their brokerage statement and I see what their broker's selling them, they don't know about T-bills. The broker's not showing them T-bills, even though it's probably better for the client. As I already showed you on a net basis, it's definitely in their best interest. The broker's not showing the client T-bills because they can't get paid. There's almost no commission on T-bills, so brokers don't like to sell them. They would prefer to sell you CDs where they can get paid more money, and it's all hidden, right? If they're doing it on a brokerage basis, you're not going to see those commissions. And I think this is the reason why a lot of people don't buy T-bills for their conservative elements of their portfolio, because they're working with a broker who's peddling them CDs. The final element for our analysis of CDs versus T-bills is risk. CDs have more risk than T-bills. It's that simple. Many people don't know that, but those are the facts. When you give your money to a bank in the form of a CD, a certificate of deposit, when you invest in a CD, the bank takes that money and then loans it out at a higher interest rate than what they are paying you. Your certificate of deposit is actually a liability for the bank, right? They're paying you interest. And the idea is that they're going to loan your money out at a higher interest rate. So here's where the risk comes in relative to a T-bill. The bank can fail. And now you have to rely upon FDIC insurance. Now, many people feel very safe with that, and I believe it is safe. But on a true risk basis, a CD, in my opinion, is much more risky than a T-bill. A T-bill is going to be more liquid than a CD. You'll probably get a comparable or better interest rate, and on a net basis, you'll make more money, but it's also going to be backed by the U.S. government. If things get really bad, I think you're going to survive more likely with a T-bill than a CD. I mean, think about that. If we have another depression and FDIC runs out of money and gets turned upside down, you're probably going to be better off with the U.S. government in a T-bill than you will be in a bank CD. So risk is going to be more for a CD and less for a T-bill, in my opinion. So let's sum it all up. T-bills win over CDs on taxes, they win on fees and commissions, and they win on risk and liquidity. All three categories. I think it's a no-brainer. If you're looking to do conservative investing, consider T-bills over CDs. And if your broker doesn't want to invest in T-bills for you, that's because he or she is getting paid hidden commissions on CDs and doesn't want to show you something that they don't get paid on. They don't want to do that gratis. I hope this video was helpful. I hope it gets you thinking, helps you better evaluate your investments, and overall improve your family's financial plan.